So what is worse than a bear market? A boring stock market. And it looks like that is what's happening. I mean, I read a lot of articles about market, the leaders when they talk about markets and where the economy is headed and so on and so forth. But nothing is interesting enough to get me engaged for more than a few seconds because all of them talk about the same damn thing. So don't be fooled with the daily drama of the market. Few points up and a few points down, and every run up or every slowdown is not a direction that market is taking. S&P 500 has stayed same within that 100-point range over the past 2 weeks. So if you have not looked at your account for the past 2 weeks, it would still be the same where you left it 2 weeks ago. We actually have become obsessed with the Federal Reserve and what they are going to do or not going to do. Is recession happening? Will inflation cool down? I mean, come on, enough of this already. I didn't release a single video yesterday because nothing was interesting enough. It was the same old story over and over again. So let's talk about 3 trends that is taking place in the market and how I see it. And we as small retailers, what can we learn and how can we take advantage of that? So let's start with the inflows and the reasoning or the points that I'm sharing with you. This is my, of course, personal opinion. These are the things I look at before debating about how and when to enter the market, or basically not enter the market and still keep sitting on the sidelines. So let's start with the inflows in the market and what they're telling us about the market. So let me share the chart quickly here. Okay, so this is an inflow table and it's not going to say much over here if you look at it, but when I break it down as per the sectors, then you will see what's going on here. So total inflows in May was 68,620. The total inflows / outflows in April was 10,022. The total inflows in the market in March was 96,610. In February was 79,099. Okay. Now, if you look at it, these are in millions, by the way. So if you look at it really over here, what's going on is that we are seeing the total outflow in April that happened. Then May had a big inflow, not as big as March and February, but May had a big inflow, followed by June, which is just first 10 days. We already have about 6 million of inflows in the funds. But see what's going on here. Both equity in terms of growth and value is actually had outflows in June so far. But if you look over here in May, you will see inflows. In April, we had outflows. So people put their money in, but in June so far, they are not putting money in value or growth. They are actually going with the blend. The ETFs that tracks both value and growth because nobody knows which direction the market is going to go. So that's what they're doing. Take a look at the fixed income. So fixed income actually had an inflow right here. All this aggregated, basically everything from beginning to now, because people are now going in and they are saying, I'm done with picking individual stocks. And I just want to pick basically a fund or a ETF that gives me fixed income. So that's why you see a total fixed income inflow we had in the last few, I would say, months. But in June so far, we had an outflow in fixed income. That means people are taking a bit more risky bet. 1 second here, sorry, I'm sweating a lot. Okay, so people take a bit more risky bet when it comes to, in terms of in June. Okay, but check this out. This is investor type. This is ETFs used by traders, ETF used by buy and hold investors. Take a look over here. We had an outflow so far in the week. This is tracked weekly, by the way. So if you see over here, we have these outflow and inflows ETF used by the traders, and traders are getting out right now. And it has a very, very, I would say, cool correlation, what I'm about to tell you. Then ETF used by buy and hold investors had an inflow. So people like investors, those who are looking for a few months out, they're basically staying in, they're buying, they're more inflow. If you see over here, last week we had about 1.9 and then this week we had about 2.8. Then if you see over here, gold, US treasuries, they all had outflows in June 3rd week, which is of course, if you look at it, people are not putting money in gold anymore because they think gold is not going anywhere because with all this, gold didn't really do much. Then on top of that, if you see over here, I'm gonna actually get out so you can see the whole thing. There you go. Actually, no, this. Okay, so if you see over here, we have this risk on and risk off. See that here? So risk on and risk off, they both had outflows. So if you pay attention here, we had this inflow in the month or in the week of 527. Then we had on 520, we had risk on, people took money out, and risk off, people were more bearish. And now people are just taking money out because you know what's coming? The CPI data is coming and the Fed is going to come, and they basically give direction. Either it's going to be really bad or it's going to be really good, and we're going to see, you know, a green for a few days followed by red, or we are going to see deep red followed by a few green days. Okay, along with that, take a look at over here. So hedge funds that make both bearish and bullish equity wagers increased their macro bets in May as the market staged a late month rebound. Their net purchases of products such as exchange traded funds, which is ETF, reached the highest level since November of 2020. So people are putting money in ETFs, and as we saw over here, showed you over here, that blend is what people are putting money in. They're not going with value or growth. They're basically putting money in a blend. Client data compiled by Goldman Sachs. Okay, now take a look over here. So this is a inflationary pressure expected. This is basically talking about how some economists are saying that we are going to see a year-end rally, a second half rally in S&P 500 because of this metric right here. They're saying that the supply or supply delivery times have improved, and they are going to actually come close to the 2019 level right here, which is 2019 was right here. So they're saying that some of the supply chain issues have eased so much that we are going to see the same 2019 levels very soon, which is of course very bullish sign, but it's only for certain sectors. They're talking about average regional Fed's delivery time index Z-scores and supply delivery times improved. We know from Target, we know from Walmart that they have so much inventory right now laying around. That is what's causing this particular thing to drop, basically supply, or they don't have to wait that long to get the items. Pay attention to this. Total credit and debit card spending remains well above 2019 levels. So this is where economists are coming out, and they are basically saying that we are going to get a bull rally or a second half, a strong second half of 2022, which is very exciting for some economists. But same company, same firm, there are other economists who are coming out and saying we have a hurricane coming. Jamie Dimon right here. Okay. Even pros of the same firm can agree on the market and economic outlook. While JP Morgan chief executive Jamie Dimon warned about economic hurricane, the firm's strategist Marco said the economy will be able to avoid a recession, helping propel a recovery in stocks later this year. And Citigroup also similar clash played out. So this is what's going on in the markets right now. On top of that, listen to this. 22 fund managers were surveyed, and half of them said that they will be a seller when S&P reaches 4,200 to 4,300 level, and will be a buyer when S&P touches 3,600 level. And the biggest reason why market is trading sideways and will trade sideways is because most of us have become short-term traders. I mean, I used to look at making 25-30% on an option before getting out of it. And for long-term plays like Tesla, Apple, Google, or SoFi, I would not even consider selling them at all. But now I'm happy to make 10 to 15% on short-term trades, like FNGU is one that I continuously do, but I would wait for FNGU even to come like 30% and then I will cash out. But FNGU, 10%, 12%, I'm out. I'm not doing options right now because these markets are really a killer for option. But few stocks I'm okay with trading, like FNGU, and also like, for example, if Apple reaches 182.50, I'm trimming my position in Apple because I think that has a very strong resistance level for Apple. And like we saw with Berkshire Hathaway, I had a auto sell at 500,000, it clicked and I sold it, and I'm like, oh my God, why did I sell so quickly? Because Berkshire was really in the news at that time during the earnings time I'm talking about. And the stock actually went up to 540,000. And I was like, I shouldn't have sold it, I should have kept it. But then what happened? If you check Berkshire Hathaway A right now, it's at 463 something. So I'm glad that I got out at 500 so I can have some cash, some power or powder to basically buy as we hit the down level of S&P 500. So what I'm saying is that any rally that we see in the coming days, don't trust it. and don't think that's the direction market is going to go for the rest of the year, because it changes in an instant. These things are changing in an instant. Even the firm's CEO and the strategist that I just showed you, this clip right here, or this article right here, that they can't even agree on that. Jamie Dimon and other person Marco, they cannot even agree within the firm. One is saying we have a hurricane coming, the other one is saying we're going to avoid recession and stock is going to go higher. So these are all very confusing times. One of the most confusing time that I have witnessed in my investing career. And we don't know which direction the market is going to go. But we have some very important data that is going to land this Friday, and I'm going to do a video of that before and after. And also next week when FOMC comes out. But that will largely depend on what we get on Friday. So if topic like that interests you, definitely subscribe to the channel and hit the like button so our video can reach out to more investors and of course more stock market lovers. Thank you so much for joining me. Until next time, you all have a sparkling day.